Welcome to the special report here at XM.com. I'm Christina Marujos. Joining me today is lead investment analyst Rafi Boyajian, and we'll be having a look at central banks versus market pricing for rate hike expectations. What's going on there exactly? Rafi, we're seeing inflation creeping higher globally. Just yesterday, the U.S. reported a shocking 6.2% year on year in its CPI, while the Fed insists this inflationary episode will be transitory and therefore has pushed back market expectations of an early rate hike. Why do you think markets don't truly buy into the transitory inflation narrative?
Well, Christina, that is becoming a really hot topic right now. And the question as to whether markets are right or whether central banks are right in terms of their own predictions. So the Fed was seen to be pushing back against expectations of an early rate hike at its November meeting. But in reality, Chair Powell was merely trying to sidestep the issue by focusing on the tapering decision and avoid talking about a liftoff. And in fact, there were several hints from Powell that the Fed could be ready to raise rates by the middle of next year. For example, he did say that maximum employment goal could be met by the middle of next year. And he also suggested that the Fed was open to adjusting the pace of its tapering. So we could see tapering end much sooner and perhaps rates start to rise by the middle of next year. But despite all that, Chair Powell did really portray the picture that the Fed will be patient on rates. So that's why markets perceived it as to be dovish. But in fact, Powell gave his strongest indication that the Fed is ready to respond should the transitory inflation narrative fall apart. And because the Fed is doing a better job of communicating its policy decisions, market pricing of interest rate hikes aren't as aggressive for the Fed as for other central banks. So even though in the scenario that inflation proves to be not so transitory, the US economy would probably be able to withstand higher rates more than other economies. Markets are not second-guessing the Fed because of the Fed doing a generally better job of communicating with investors.
However, it's not just the Fed, because we've also seen the Bank of England and the Reserve Bank of Australia attempt to calm speculation of aggressive rate hikes. So who should we believe, the markets or central banks?
Well, in case of the RBA, they were a bit too dovish, or in fact quite dovish to begin with. So investors were right to think that the rate hike timeline of 2024 was just wishful thinking on the part of policymakers. However, after their last meeting when the RBA signaled that rates could start to rise perhaps in 2023, markets are still expecting several rate hikes in 2022. Now, this is probably too aggressive because there are several risks hanging over the Australian economy lately. So even if the RBA were to bring forward liftoff to 2022, it's doubtful they would be able to raise rates as much as 4 times, which is what money markets are currently indicating. Now, for the Bank of England, they were quite hawkish in the build-up to their November policy meeting, but they did a poor job of guiding market expectations. So they ended up keeping rates on hold, even though they had signaled that they would be raising them. Also, the difference with the BOE is that they will almost certainly raise rates in the coming months, probably in February. The problem is markets are pricing a 100 basis points increase in the bank rate, which seems way too hawkish. So like the RBA, there is room for disappointments with the BOE.
And now all the speculation of rate hikes, as well as volatility in bond markets, has been making quite a mark on the major currencies lately. Which currencies are more at risk if it turns out that markets have gotten quite a bit ahead of themselves?
So given that it's unlikely that neither the RBA nor the BOE will be able to raise rates as many times as investors currently think, the pound and Aussie are at risk of a sharp sell-off if down the line market expectations are adjusted to become more aligned with those of policymakers. Another currency that's also at risk from overly aggressive rate hike bets is the euro, though nowhere near on the same scale as the Aussie and the pound. So on the other side of the coin, though, are the Canadian and New Zealand dollars, as their economies are in relatively stronger positions to cope with higher rates. The risks to the US dollar are also more on the upside than the downside, not just because the outlook for the US economy is notably more positive than its peers in any scenario, but also because the dollar would likely benefit from being the world's reserve currency should we end up in an environment of stagflation.
Rafi, thank you for joining me today, and thank you for watching the special report here at XM.com.